Chintan Haria, Fund Manager with ICICI Prudential Mutual Fund, joins us right now. Thank you so much for joining us, Mr. Haria. The last time you came on our channel, you were bullish on pharma. If I remember correctly, you had said that you think that pharma is going to do well. You had a view on gas, oil and gas, and power. These were the three sectors that you were bullish on, and that was right after the Q4 numbers had come out, and we've now seen Q1 of the next fiscal. Are the calls more or less the same?
Yeah, so we still continue to like pharmaceutical sector. If you've seen in the last 1 year or so, after the correction that has happened in 2015 in the pharma sector, there has been a good valuation derating that has happened in pharma. And if you look at the demographics in India, over the next 3 to 5 years, clearly pharma sector will stand out in terms of the inherent potential growth. If you look at the oil and gas sector, there are certain parts of the oil and gas sector which have seen a re-rating. However, now we believe that the upstream oil and gas sector, which is the oil producers, are relatively cheaper than the market, and they should contribute going forward over the next 2 years or so. Given that our view on oil is that oil cannot remain below 40 for long. Ideally, oil will be around $60. That is the equilibrium price between the producers and the consumers. So over the next 18 months, oil should stabilize around the $60 to $65 mark. So upstream oil and gas looks good to us. And banking as a sector, if the economy has to grow and we are seeing nominal inflation come back, that coupled with GDP growth over the next 2 to 3 years forecasted to be about 7%, that means that the banking sector, which has been seeing problems as far as credit growth is concerned, with the economy reviving and the domestic demand picking up, credit growth in the banking sector will improve, and that would mean that banking sector's balance sheet will expand. So even banking sector from a 2 to 3 year point of view is something which looks good among the sectors.
Right, I was just looking at your top performing funds on a 3-month or even a 6-month basis. Then banking is clearly the one which is performing the best for your fund house, and you have big holdings. I'm just looking at the portfolio that has been declared recently, and of course this is public document. Significant overweight on financials, even in some of your multi-cap funds, right? So the bet clearly seems to be on financials. Could you give us the logic why you think that?
So financials generally have a 1.5% multiplier as far as the economy is concerned and the economic growth is concerned. We have seen that there has been a consolidation phase in the financial sector over the last 3 to 4 years, wherein a lot of the lending or the NPA issues have been resolved. A lot of the problems as far as the structural problems which the banking was facing, I think the RBI has taken enough measures to ensure that the banking system is now well consolidated, and going forward the growth can be sustainable and in the right manner. And with the economy picking up, like I just mentioned, there is a lot of scope for the banking system to actually expand. We must remember that India's banking system is still very small when we see compared to the developed nations or developed countries, and with an economy which is going from $2 trillion to $3 trillion over the next 3 to 5 years, there is definitely a scope that banking sector will see growth, and that's where the optimism on the banking sector is well placed, and we believe that over the next 2 years banking as a sector will continue to contribute as far as the markets are concerned and as far as the India's growth is concerned.
If I look at one of your best performing funds, and this one is called ICICI Prudential Banking and Financial Services Fund, and here the clear bias seems to be on private banks, and this includes the new age ones, because I can see HDFC Bank is clearly the biggest holding, then there's Yes Bank comes after that, ICICI Bank after that, then you also have IndusInd, you have Repco Home Finance, of course PSU, but you have SBI, you have Punjab National Bank, but the bias seems to be towards private banks. Again, why is that the case?
So if you look at the past 6 to 7 years and going forward over the next 3 years as well, we have seen a significant shift of market share as far as the banking system is concerned. So PSU banking used to be about 80% of the banking system. That is gradually come down to about 72 to 73% of the banking system. And so it's clear shift from PSU sector to private sector as far as the banking system share is concerned. And that's where, as India is growing and the power or the share is also shifting in the hands of the private sector, it is a more stable, consistent growth that we are seeing in terms of the private sector. And that's where probably the fund manager is actually having a larger weight on a more consistent, long-term, sustainable private sector banking. At the same time, because the valuations of the PSU banking is cheaper compared to their past, it makes sense to have some amount of PSU banking tactically to ensure that when they get re-rated, we also benefit from the re-rating. So as a core portfolio, you'll normally find that the private sector and the private sector entities in the financial space are something which will remain, while tactically on the PSU banking side, because the valuations are very cheap, it makes sense to hold the PSU banking and play the re-rating for temporarily, and then probably again get out from the PSU banking space when the re-rating has happened.
Okay. If I had to differentiate between the banks and NBFCs, now obviously NBFCs have a much higher net interest margin, they're growing faster, but also some would argue that NBFCs have a limit to growth. Once they start growing beyond a certain amount, they will acquire all the trappings of a bank. So do you think NBFCs are now starting to reach that saturation level, getting too expensive, and growth that is being projected will start to taper off?
So obviously the NBFCs as a space has actually done pretty well over the last 2 years or so. In fact, the last 6 to 8 months has seen a significant amount of re-rating in the NBFCs. We believe that on valuations, they are expensive. There is scope for growth over the next 2 to 3 years in NBFCs as well. But relative to the private banking space and relative to the banking space in general, NBFCs look expensive, and to that extent, we should remain cautious on the NBFCs as a overall pack. There may be some companies which we like within the NBFCs, which have a better mechanism of actually risk management. But in general, overall, the NBFC space looks to be a bit overheated, and on valuation front, they look a bit expensive. So we remain cautious on the NBFC space and probably prefer the private banking in general over the NBFC space.
All right, let me come back to pharma a little bit, because this has been one of your favorites earlier. And if I look at pharma in terms of earnings multiples, right? We were just discussing Biocon, which has got just a new buy rating, and it technically has made a breakout as well. And it's FY18 multiple right now. Biocon is trading at close to, I think, 27, 28 times. If I look at Cipla, another favorite, FY18 multiple, earnings multiple, the consensus, it's trading at about 22 to 23 times. You look at even a cheaper stock like Aurobindo, even that has picked up quite a bit. Is pharma now, again, a little overheated in terms of valuations?
So probably on the valuation front, I'll not specifically restrict myself to pharma, but in general give you a broad answer. If you look at valuations on a PE basis, they are a reflection of what interest rates in the system are in general. So you probably have heard, or you probably have seen a lot of your investors querying you that why is the Sensex and the mid-cap PE so high, and should we be worried about the PE of mid-cap index being 33 and Sensex being 22? One, the earnings growth potential is something which will come over next 2 years. We are a believer of 12 to 14% earnings growth over next 2 years. That's a possibility. Second, with bond yields globally going below zero, the fact is that PE, or the price to earnings multiple globally, are getting re-rated in the equity space. So as globally the bond yields have come down significantly, the PEs have expanded. And that is true even for India. If you look at the interest rates in India, we were around 8.5%, 9% on the 10-year GSEC about 2 years back, 1.5 years back. We've come down to almost 7.2, 7.15 on the 10-year GSEC. And that fall means that the PE of the equity markets has to get re-rated to adjust for the falling bond yields. Yeah. And that's where the systemic PE has actually gone up. And that would be true for the pharma sector as well. If you look at the pharma sector, it is trading at above its long-term average PE. But this is a sector where the cash flows are reasonably strong, where the growth is, because it is a inherent demography related growth, and Indian companies have actually achieved supremacy even in the exports market. If you look at the US or if you look at even the European markets, Indian companies have actually done very well within the pharma export space. And we believe that this will continue over the next 2 years, and that space is only going to grow bigger. And hence, even though pharma on a long-term average basis or the PEs may be higher, one, because of the lower bond yields globally, two, because of the fact that pharma provides consistency of growth, and being demography related, there is no problem as far as the growth is concerned in pharma. We believe that the price to earnings multiples of pharma will remain elevated, and the earnings growth which will happen over the next 3 to 5 years will justify the higher earnings in pharma as well as in some of the other quality names which probably are trading at a little bit above the long-term average PE. There are names in the market which are very expensive, about 30, 40 PE. We do not necessarily like them, we do not necessarily own them. But in general, if you look at price to earnings, if a stock was trading at 14, 15 PE, then because of the falling global yields, there is a high probability that that stock may trade at 18, 19 PE on a sustainable basis, purely a function of lower global bond yields.
The only question that I would have to that is that indicates that some sort of a bubble is building up, right? Because when you have the cost of funds are so low, earnings are going to expand, then you're effectively saying that the returns on just finance is going to be lower than return is significantly lower. Returns on finance are negative. Returns on equities or equity assets through earnings are growing. So that divergence is essentially pointing towards a bubble.
So on the point of bubble, we were actually doing some work on where we were as a country in 2007 versus where we are today in 2016.
Right.
And around 5 or 6 indicators is something which we tried to compare with. So while on a PE basis in 2007, which was considered as a bubble in hindsight, we were at 27, 28 times. Today we are at 22, 23 times.
Okay.
That's a little bit more comparable. But if you look at on a price to book basis, we were at around 5 plus at that point of time. Today we are at about 3 on a price to book basis, which doesn't look expensive relative to what it was in 2007. If we look at the sentiments in 2007, we were in a euphoric sentiment. In 2016, if I look at it, most of us are running the car with a handbrake on. So there is some amount of skepticism, and hence again, we are nowhere close to where we were in 2007. If we look at on a capacity utilization basis in India specifically, which is a country where there is growth, and it is because it is intrinsic growth, we are quite confident that this capacity utilization will go up. Currently, we are at 68% capacity utilization. We were at close to 90% in 2007. If we look at the past returns, in 2007, past 1 year return was about 50%. Today, past 1 year return is about 10%. Also, the FII inflows were significantly higher in 2007 relative to what we've seen over the last 12 months. So all these indicators put together tell us that we are nowhere close to the bubble, so to say, which in hindsight in 2007 we were in. So both on technical front, on liquidity front, and on valuation front, there may be room over the next 2 years. And also we are just at the cusp of a recovery in the economic cycle. So macro adjustment in India has happened. The micro adjustment in terms of earnings growth over the next 2 years is likely to happen. So we believe we are more like in 2006, where from 2003 to 2006 the returns were reasonably good. And 2006 to 2007 end, there was a re-rating which happened because the earnings growth was significant. And at that point of time, the entire emerging market space was doing very well, and China was the leader. We believe between 2016 and 2018, India will take the lead because India is in a far superior macro and micro position than any other emerging market. Right. And that's where there is money to be made in the equities for the investors in general, and we will continue to see domestic inflows into equities as well as the FI interest will remain high.
Okay, I'm going to take up that point about the emerging markets that you made right now, India versus the remaining emerging markets, because you had a certain view on it the last time you came on our channel. I just want to be the devil's advocate about the comparison that you made with 2007. 2007, the boom that we saw was driven largely by infrastructure stocks, right? And heavily by power, by the GMRs and companies like that, not necessarily the top indices, not necessarily Nifty, Sensex, but if I look at it, it was essentially an investment cycle that we were looking at. Globally, there was liquidity driven by global boom, and now we are seeing actually a growth coming in from the consumption sides, from what were traditionally called safe bets, traditionally called things where you essentially put your money in just to preserve it. That's what's driving the growth. Investment cycle is not there. Globally, except for the US, there is a down cycle. So therefore, I'm saying that the comparison itself would have to be adjusted, right? Because when you look at infrastructure and that drives your valuations, then earnings is not immediately the thing that you look at. So PE multiples would not have come into play. At that time, the arguments were being made about replacement costs, sum of parts, that kind of arguments were made, and not really earnings. Now we're in that space where only earnings can be talked about and not really replacement cost or sum of parts and the asset-based arguments that were made in 2007. So the two are not directly comparable. How would you react to that point?
So the good part is that we don't have to rely on things like sum of parts to explain the markets right now. The markets right now are clearly in a strong position because the earnings or the earnings growth is likely to happen over the next 2 years is because of factors which are domestic driven. You spoke of investments, and in general investments was obviously strong in 2003 to 2007 phase. We saw that investments coming down because obviously there were probably bottlenecks on government approvals, etc., as well as the global financial crisis led to a lack of appetite on the part of private capex. Because in the last 2 years there has been consolidation on government expenditure, and we've seen over the last 6 months to 12 months, especially in the road, sports, railways side, we are also hearing of water linking, river linking. There is a government push towards ensuring that these projects and government spending in infrastructure improve significantly. That should drive over the next 12 to 18 months and convert into private sector capex as well. As far as an economy becoming a consumer-driven economy is concerned, let's remember India at around 1550 per capita GDP, $1550 per capita GDP is on the cusp of a breakout. In the last 30 to 40 years, whenever an economy has crossed 1550 average per capita GDP, there has been a J curve in terms of the growth or exponential growth that we have seen in terms of consumption, in terms of the propensity of the consumers to spend on things like housing, clothing, education, in general better protein-rich food. So we will see that that part of the economy is also firing on all cylinders. So if we look at the C plus I plus G X minus M's equation of the GDP, we will find that consumption will continue to be a strong driver. So the services economy will continue to do well. Investments will need the government push, and we believe strongly that this government is in the right direction in terms of spending on infrastructure. And in fact, that's where in the last 1 month or so, we are actually pushing our infrastructure fund as well as one of the high risk, high return bets which you can take if you have a 2-year view and you believe that the infrastructure sector can pick up. Also on the, if you look at the export side, yes, exports are something which are going to be probably slower, but because we are mainly into pharma and services exports, we are not too much into commodity exports. In fact, we are commodity importers. Our terms of trade are also significantly in our favor. So like I said, the macro is significantly in our favor. The micro in terms of earnings growth is going to improve. In the entire emerging market space, you talk of comparison not being correct. Absolutely. In 2007, all the emerging market space was actually doing well. And in terms of demography in 2006-07, you had most of the emerging economies around India or emerging markets around India, the demographics in terms of the dependency ratio in their favor. So their working population was increasing in all the countries. After 10 years today, as I'm speaking to you, India is the only country whose dependency ratio is actually going to come down. Today we are at about 52% dependency ratio, so 52% of our population is dependent. That is going to come down to 47 in about 5 to 7 years time. So we are going to see a hyper growth in terms of people coming in on the work, and if we can manage a good job creation environment, which is tough we know, but the government is doing all it can. And in general, the economy is able to deliver 12 to 13% GDP growth on a nominal basis. There is no doubt that a lot of the FI and FDI investment, India is anyways the largest FDI receiver in the last 12 months or so, and we believe this will continue. And with the global bond market being where it is, like you mentioned in negative interest rate, will it lead to a bubble? There is a chance that this global liquidity comes in big way in India and can eventually create a bubble in 2018-19. but that's something which we will wait for in 2018-19. As of now, it's a good environment as far as equity markets are concerned.
So just last time when we were speaking to you, you had said that India is the only emerging market which has seen fund flows. Others haven't. In the last 3-4 months of that liquidity slosh that we've seen, that the money has come in, few emerging markets appear to have performed slightly better than us. Now, are you betting that that's going to continue, or is that going to get reversed and actually India will catch up even more than what it was in the last 3 months?
So what we've observed over the last 2 to 3 years is that India has become, because of the consistency and stability, India is a low beta market. So whenever there is a significant fall in emerging markets because of ETF redemptions, India tends to outperform significantly. And when there is, in the last 3 months, we've seen that there is a clear shift of money from developed markets to emerging markets. So between 2010 and 2014, money was actually moving out of emerging markets. And since the beginning of 2016, specifically since March, and more so from Brexit Day, there has been a shift from developed to emerging markets. We're clearly seeing funds being moved to emerging markets probably in a yield chase mode. And some of the emerging markets, probably like Brazil, had become very cheap. And with commodity prices seeing a rebound, Brazil has obviously done very well because it was extremely cheap and its currency has also done much better. So what had fallen a lot in the emerging markets has done probably better than India in terms of the last 3 months.
Yeah.
However, on a 3 to 5 year basis, India has still been one of the better performers. And we believe the consistency and the intrinsic growth of India is something which will continue to attract investors and FIs a lot more to India, because we are less dependent on the external world, less dependent on the commodities world. And as of now, our belief is commodities will stabilize and marginally go up over the next 2 years. But probably the investors would want to bet on an economy which has a stable government, stable RBI policy in terms of its continuity. The currency is stable, and the earnings growth, more so importantly, are very, very intrinsic, and we probably have a visibility of earnings growth as well in India. So India will continue to be a very, very intrinsically important part of an FI portfolio.
Right.
We are already the most overweighted emerging market if we look at the entire emerging market portfolio of FIs, and we believe that this will continue, and we will continue to attract a large share of the FIs. Will it get distributed among the other emerging markets? Yes, it will get distributed among the emerging markets, but just the sheer amount of money that can come from bonds in the developed markets is so high that we all will probably see that we may surpass 2007 in terms of the flows that are potentially possible into India.
Okay, since you both talk to companies on a regular basis and also do a lot of data analysis, I'm going to ask the 2 questions which are related to that. Let me start with the data part. The last time you came to us, it was right after the Q4 earnings. Q1, what are the details that you found? We've seen the numbers come out. They're more or less what the markets expected, not significantly above or not significantly below. But in the fine print, what did you find? What did you read?
So based on what we've seen, and this was the first time that the numbers had come on the index, so to that extent, the comparables weren't possible with the previous quarter. However, if we compare YOY and index, the Indian accounting standards, the numbers have been reasonably okay. Are they great? Probably not. But we expected till September the numbers to be subdued. And having spoken to a few companies on the ground, things definitely have improved on the ground in terms of the visibility of business for most of the companies, specifically in the roads and railway space. However, in general, even the cement companies are pretty upbeat, and we have seen that housing finance as a sector has been reasonably okay. There is definite pickup in low-cost housing in the Tier 2, Tier 3 cities. However, in the larger cities, there remains a problem of inventory, and that may not probably go away over the next 3 years. But in general, if you look at the entire space, be it pharma, be it probably IT has been a bit weaker. And we believe that IT stocks today are probably going to see 1 year of consolidation. But given their high given their high cash generation capabilities, they may not get derated significantly. So on an overall basis, both June and September may not be that great. However, with monsoons being good and consumption pickup happening, we believe that probably from December and March 2017, December 2016 and March 2017, we will see that earnings growth kicking in, and that's where the optimism on the equity side that we have.
Yeah, let me just break that up a little bit. You know, the previous quarter, if we saw the way in which companies essentially expanded their margins or expanded their profitability, was top line growth was muted. It wasn't that great, but they managed to cut down costs. Part of that was because of the commodity cycle having been, going towards its bottom. And part of it was because better efficiencies brought in. Everyone probably has learned that you have to cut down costs. Don't expand too much. There's been some restructuring, not taking too much debt on the books. That was what led to expansion in margins and profitability in the previous quarter. What new did you see here in this quarter? What changed in terms of business strategy, in terms of the way in which companies were working on their business?
So I think that consolidation on the part of the private sector specifically has continued. We have seen that the private sector has actually had a big push in terms of reduction in their debt, and that has continued even this quarter. But going forward with the earnings, or rather the significant growth which we may see in capex happening, this debt coming down, or the fear of the private sector of actually not having projects working on the ground, and that's why they are not expanding their balance sheet, that may go away, and that's where our optimism on the banking side as well. So for the banking sector to grow, the private sector has to actually start raising a lot of or rather taking a lot of credit, and with commodity cycle improving. So you mentioned about, because of the commodity fall, the top line was muted. If we look at oil, crude oil, it has actually bounced back a little bit from the lows of December. And also in general, most of the commodities have actually seen a bounce back. And that means that the top line and bottom line of the commodity companies will do well. So the optimism on earnings over the next 2 years, if you look at it, is on two fronts. One, the write-offs that have happened on the banking sector and the banking system because of NPAs will no longer be required, or will no longer be there in 2017 and 2018. And that is a 30% of the weightage of the Nifty. So that delta can add to the Nifty's earnings growth. And also the commodity plays, or the commodity companies, which probably have a lower weight in Nifty but have a higher weight in terms of the profits as far as Nifty is concerned, that can turn, because with the commodity prices improving, their earnings or EBITDA will improve significantly. So there is a qualitative improvement which we see that can happen in the Nifty earnings, mainly on account of banking system actually doing much better in terms of profitability, and second is in terms of commodity companies doing much better than what they have over the last 2 years. So that delta should help us. And then the third part is, because of the good monsoons, the consumption and the J-curve of consumption which I mentioned can mean that the consumer focused or consumer related companies can also start showing much better numbers than what they have shown over the last 2 years, because they suffered from a lower rural growth because of the two bad monsoons.
All right, Chintan Haria, thank you so much for taking our time for us. Pleasure talking to you. Thanks a lot.